Tomorrow, by this time, we would know what the Reserve Bank and the Monetary Policy Committee would have said about and done to the interest rates. The CNBC TV18 poll says the market unanimously doesn't expect a change in rates or in the stance. Then what will the policy convey at all? Given the recent volatility in US yields, will it tighten liquidity to keep short-term interest rates high? What else should one watch out for? Just as a last-minute wrap of what to expect and what to watch, I have with me two experts, Ashhish Vaidya, the head markets at DBS Bank India, and Suyash Choudhary, head fixed income at Bandhan Mutual Fund. Gentlemen, thank you very much for your time. Ashhish, well, first you. How much do you think, how much of the policy will be reacting to this very high US yields? Will the Reserve Bank actually, do something to keep the interbank call rate at 6.75 rather than 6.5?
So I think, Latha, for tomorrow's policy, clearly the volatility which we have seen in the rates will have its own bearing. Having said that, like you mentioned, I think, and I'm also with everybody else in the market, I don't think we are expecting any change in the rates as such. But liquidity, like you mentioned, is going to be at the center of the policy, and I think they will continue to keep the liquidity tighter. In fact, I will not be surprised to see some more permanent kind of liquidity measures that might actually come in, because we have seen the inflation actually rise over the last few months, and we have seen some sort of fall, but the inflation impulse across in the world is still not fading. So my sense is liquidity is going to be the key, and that's going to be kept tight. The days of easy liquidity are over for now, unless we have some sort of a hard landing and then the central banks decide to revert. Till then, I think the picture is basically centered around liquidity reduction.
Oh, permanent measure to reduce liquidity. You're saying a CRR hike?
A possibility, not necessarily in tomorrow's policy, but an indication that this could become a reality.
Okay.
I think RBI has clearly mentioned that they are focusing on liquidity. And I think that's very important.
Okay. Suyash, what about you? I mean, Ashish is not the first person to tell me that I won't be surprised with something like a CRR hike, though that's not their base case. What's your case? You think something as big as that will come?
So, Latha, if you refer to the last policy, the governor clearly seemed to indicate that he needs more transmission on lending rates. And I completely agree with Ashish that the focus, therefore, is to keep liquidity tight, through the busy season, keep the pressure on the liability side for lenders, and therefore ensure that more transmission happens to lending rates as well. Now, if you see the liquidity or the core system liquidity, what we call X of government cash balances, post this ICRR unwind, it should be of the order of 3,25,000 crores. By financial year end, around 2,50,000 crore leaks out as currency in circulation. We also expect probably the RBI will have to do some additional dollar sales over the course of the next few months. So on its own, core liquidity heads towards the 50 to 75,000 mark by March. So prima facie, the RBI may not need permanent measures per se, but I agree that the endeavor will be to keep fixing closer to the MSF rather than the repo rate. And therefore, short-term measures that they have been undertaking so far are likely to continue.
Okay. Well, so a CRR hike is not your base case. Ashish, it's not your base case either, right? You're saying that you won't be surprised.
No, absolutely, you're right. It's not my base case, but I will not be surprised also.
Okay. I just want to read out to, I know for the two of you, this will be, you would have learned it by heart. But for those who don't follow monetary policy as passionately as you and I do, you remember what DG Patra, Michael Patra wrote in the minutes to the August meeting. And these are powerful words. I'm just quoting. A risk to the inflation outlook stems from the liquidity overhang in the banking system. Withdrawal of excess liquidity should engage primacy in the attention of the Reserve Bank going forward, as it presents a direct threat to the RBI MPC resolve to align India's inflation with the target besides the potential risk to financial stability? So, I mean, it was as direct as that. Ashhish, is there any midway between, a CRR hike and something else? See, they can always do a reverse repo and keep on draining liquidity. But can you think of something innovative? Because the Reserve Bank does come with something innovative. Any ideas?
No, for now, I really can't think. I think if at all, they can either extend the ICRR or they might come up with some sort of a CRR increase, maybe marginally, because banks will really cry foul if there's a CRR increase. It's actually hits their bottom line. But I think there is a choice between the two. RBI has already got an ICRR, which is a new instrument, and I don't think they're getting away from that very soon.
Yeah, ICRR, if they really intended to keep it, they would not have wound it down. The last tranche of money is coming back on October 7th. 50,000 crore will hit the market. They wouldn't have done that if they wanted to continue with it, I would assume. Suyash, is there an outside chance of, 10 basis rate hike types, where you don't want to really do a rate hike, but still indicate your caution? Is there a possibility at all?
We are not, kind of accounting for it. Of course, it's always a possibility because if you see, RBI has always stated that they are clearly domestic focused, inflation focused. If anything, the vegetable price unwind has happened slightly quicker than expected. Then the government continues to take proactive supply side steps, including the recent LPG price cut, which is directly bringing down headline CPI by of the order of 20 basis points. So, granted, the external volatilities and the recent commodity price rises, but at this juncture, we don't think the RBI wants to signal that way. Although they would continue to signal that every policy is live, and therefore, December is not clearly out of the way as far as the possibility of a rate hike is concerned. But to be clear, our house view remains that the rate cycle in India has peaked, and the focus is more on liquidity withdrawal and active liquidity management, so as to ensure more transmission to lending rates of the policy hikes that have been already undertaken.
Okay. To be fair, this 10 basis rate hike, only one out of the literally 100 people I must have spoken to in the market came up with very half-heartedly. What else would you watch out for, Ashhish? Do you think they can depict their caution by higher than expected inflation forecast for FY25? Tomorrow we will get the first look at RBI's FY25 CPI forecast. What do you expect?
So as far as the inflation forecast is concerned, I'm not in the camp that they're going to change anything. I think it's a wait and watch. I think important...
No, it will be a new forecast. No, Ashhish. They've only given us till Q1 of FY25, which at the moment they are saying is 5.2. They have not given us an FY25 forecast. The monetary policy report comes. MPR will come out tomorrow. So, I mean, anything that you will look out for?
No, if they're going to give a longer term forecast, I think, that's going to be important. But, Latha, aside from the inflation bit, I think I would want to draw your attention also on
Ashhish, I have a problem. I have a problem hearing you. I think you will have to repeat that. Let me do one thing. Let me go to Suyash and we'll fix that audio. Suyash, just a blank check question. Anything else that you would expect as well in terms of forecasts?
No, I would think, the inflation forecast will give some comfort that there is an adequate amount of real positive rate that already exists in the system. But, the state of the world being as it is, no central bank can actually take it easy. And therefore, there will be abundant caution and abundant guidance that everything is live for the future. Like I said, the focus will remain on liquidity withdrawal. Don't forget, RBI also has been doing some marginal OMO sales via the secondary market lately. So clearly, they are also deploying some permanent tools, even though they are doing it little quietly and not very publicly.
You mean the bond sales in the open market, right?
That's right. They have been doing some OMO sales of government bonds over the last few weeks.
Okay. Yeah, I heard about that, a few thousand crores or even less. But Suyash, do you all have any in-house expectations in terms of the CPI forecast? I mean, if it were like 4 to 4.5 for March quarter of FY25, the market will be will be happy about it. They will be expecting rate cuts. Any number, any guesses? How should we interpret if the March quarter is like 4.8 or if the March quarter is 5?
So the market will take everything, in a way that what does it mean as a real positive policy rate? So basically repo rate minus forward forecasted inflation. If it's of the order that you suggest, then market will be relieved that, the policy rate is already adequately tight in real terms. Having said that, in the world that we are living in, it's hard to see inflation below 5% sustainably, given the, repeated food shocks that the RBI also refers to from time to time, as well as the volatility that you're seeing in the commodity market. So our base case is, the real positive rate is roughly in the 1 to 1.5% vicinity, which is not extraordinarily tight, but probably suffices for India, given that over the last 2 to 3 years, our post-pandemic response from the fiscal side was reasonably modest and well thought out, which is very unlike what we have seen in developed markets, chiefly the US, where a large part of the inflation problem today is courtesy the aggressive fiscal response that happened over 20 to 21, as well as the lack of consolidation adequately even in 2023.
Okay. Actually, the US fiscal deficit is below 8%. Unusual for them, but it's still below 8%. Our combined fiscal deficit is 9%. So yes, we are modest by our standards. We did not go berserk, but 9% is not something that we should be too glad about. And it's an election year. So, Ashhish, 2 very quick questions. Will this possibility of a fiscal breach, add to Reserve Bank's caution? After all, it's an election year. And we've already seen the first elements of cheaper gas cylinders and probably a housing subsidy coming by. Is that a worry? And secondly, can they even go beyond this? There was someone suggesting maybe they will raise risk weights on premium housing loans. Anything like that?
So RBI is going to be is cautious and is going to be worried on the fiscal side for sure. They are not going to be mentioning that because of the fiscal because of the election year, but clearly it's very evident that they are worried. Because and I think my connection got lost, but I wanted to draw your attention on the overall macro piece, which is basically look at the dollar strength, the way the dollar is behaving. So while RBI does mention that we don't look at managing the currency rates, but RBI will have to keep liquidity tight or rates higher for longer just to manage the currency as well, unless we start getting huge inflows from the index inclusion. I think that's the only way to look at it. Otherwise, I'm not seeing much thought process within RBI. I think it's an evolving situation. Like everybody else, I think we're going to just watch out as to what are the things happening in the next steps.
Okay. Well, actually, the dollar strength is already impacting us, or rather the high US yields. I don't know if you all noticed the BOP numbers, balance of payments numbers for the June quarter and the March quarter. Remittances fell in India. We've been having almost quarter after quarter Indians sending money abroad only increasing. It reached a peak of 30 billion in October to December quarter. Both the Jan-March quarter and the April-June quarter were a billion less. And so there are some people who want to keep money out because you're getting 5% for dollar savings. So that's something that RBI perhaps will have to keep on the table. Unfortunately, out of time, but I hope to have both of you very soon, probably tomorrow itself, to discuss what the Reserve Bank says. Expected to be a no-action policy, but the Reserve Bank has an uncanny way of getting in the fireworks. So hold on to your seats and we will know by this time tomorrow what they have in their minds. Thank you very much for watching this special edition of It's the Economy. Chartbusters comes up after a break.